We talked a lot about the Tangency portfolio and how it should be the risky portfolio of choice for all rational investors. But what is the Tangency portfolio? Can we determine what composition of assets it contains so we know what to invest in? To answer these questions, we need to look into the macroeconomics of the market. We can start by thinking of a simple case where the whole economy only has two companies, Company A and Company B. We are going to use specific notation and a few formulas to make the case for what the Tangency portfolio is. Please don't get caught up on details. The most important thing is for you to understand the insights from the theory. Let's start by defining the share price for Company A and Company B as SA and SB. The number of outstanding shares for each company as NA and NB. Now we can easily calculate the market value or market cap of each company as the product of the share price and the number of outstanding shares. Now we have VA as the market value for Company A and VB as the market value for Company B. The value of the market portfolio is the total market cap of all stocks. Since we only define two companies in this economy, we would have the value of the market portfolio as VA plus VB. Expanding what VA and VB mean, we know that the value of the total market is NA times SA plus NB times SB. We can now compute the return of the market portfolio over one holding period, from T0 to T1. Up here, we see the notation for the market value at time 0 and at time 1. We can represent the total market value at time 1 with the sum of the market cap of Company A at time 1 and the market cap of Company B at time 1. Market cap is calculated by multiplying the number of outstanding shares by the share price at that specific period. We can also write the total market value at time 1 as the product of the total market value at time 0 and 1 plus the rate of return on the market over this holding period. The same is true for calculating what the share price of each company is at time 1. We can expand it in terms of share price of the company at time 0 times 1 plus the rate of return of each specific company during the holding period. With a little bit of algebra, we can isolate the return on the market and get to this equation here. Looking closely, you will see that the return on the market is a weighted average of every return in this market, where the weight of the company is determined by dividing its market cap by the total market value. So the market portfolio is a value-weighted portfolio of the market. This is an important insight, but by itself, not enough to help us understand what the Tangency portfolio is. To do that, we're going to have to introduce investors in our economy. Now, suppose that there are only 3 investors in the market. Here's the notation for the number of A shares that each of these investors have and the number of B shares. And here is the notation for the value of their individual investment. We know that the value of the investment for each investor is the sum of their investment in Company A and the investment in Company B. These numbers can be calculated by multiplying the number of shares they have in that specific company and the stock price of that company. If we assume market equilibrium, meaning investors have bought and sold whatever they wanted to buy and sell, and that supply equals total demand, there's nothing left over in this market. We can say that the total number of shares for company A is equal to the sum of shares that each individual investor has for company A. The same is true for company B. And we can also say that the total value of the market equals to the sum of each individual investor's investment in this market. Now, suppose that investors are rational. And being rational, they invest in the Tangency Portfolio, which is the most efficient portfolio of risky assets, having the highest Sharpe ratio and giving the highest return per unit of volatility. We can write three equations to represent each individual investor's investment as a percentage of their investment in the overall Tangency Portfolio. Lambda here is representing this percentage. We can also add these three equations up and get to this new equation here, where the sum of all the individual investments equals to the sum of the percentage of their investments in the Tangency Portfolio times the overall value of the Tangency Portfolio. We know that the lambdas must add up to 1 because investors are rational and they invest in the Tangency Portfolio. With that, we get to our final result, which states that the sum of each individual investor's investment is equal to the Tangency Portfolio, which we know from this equation up here is equal to the market portfolio. So in economic equilibrium, the Tangency Portfolio should be equal to a value-weighted portfolio of the market. The simplified case, where the economy only has 2 companies and 3 investors, helped us understand what the Tangency Portfolio is. This is the reason why advocates of passive investing say that most people should just invest in the market index, and that they would be better off by selecting a low-cost index ETF than paying extra money for asset managers. Even Warren Buffett placed a $1 million bet in 2007, stating that in 10 years, the Standard & Poor's 500 would outperform a collection of hedge funds selected by protege partners. He won the bet. The Standard & Poor's returned 7.1% compounded annually, and the basket of funds returned only 2.2%. This makes a strong case for passive investment, and one of the reasons why we're seeing a massive migration of money from actively managed funds to low-cost ETFs. A quick note here, not all indexes are value-weighted indexes of the market. Some, for example, split the weights equally by stock, which gives us a different portfolio than the Tangency. So make sure you understand how the indexes are calculated before you invest in them. Another important reality check. The whole market is unobservable. It should include every asset in the economy, from stocks to human capital. We don't have a perfect proxy for the overall market. Most people use approximations. For instance, the Standard & Poor's 500 index, or a total US equity market index, or even a total world equity index. But still, these are approximations.